In this video, I'm going to show you how to combine multiple time frames in a simple and practical way, so you can analyze any chart from A to Z and find higher probability trading opportunities. By combining price action with smart money and ICT concepts, we'll break down how to identify market direction, key supply and demand zones, liquidity, and entry models from higher time frames down to lower time frames. By the end, you'll know how to filter out low-quality setups and focus only on trades with real A. What is top-down analysis? Top-down analysis is the process of studying price action across different time frames, starting from the higher time frames and then moving down to the lower ones. This approach allows traders to understand the bigger picture first, and then zoom in to find more precise, high-probability trade setups. Now, when using top-down analysis, there are three key time frames every trader should understand. Number one is the higher time frame. This is used to determine the dominant market direction. In simple terms, we want to know who is in control, buyers or sellers. The higher time frame gives us the overall trend, major structure, and broader market context. Number two is the analysis time frame. This is the most important time frame for planning. On this time frame, we assess market conditions, map out structure, identify key liquidity zones, and define our trading bias. This is where we decide whether we should be looking for buys, sells, or no trade at all. Number three is the entry time frame. Once our bias is clear, the entry time frame is where we zoom in to look for confirmation signals and execute the trade. So each time frame has a different purpose. The higher time frame gives us direction. The analysis time frame gives us structure and bias, and the entry time frame gives us confirmation and execution. Now, let's break them down step by step, starting with the higher time frame. Top-down analysis always starts with the higher time frame analysis. Before doing any detailed chart analysis, the first step is to focus on the daily or weekly time frame. These higher time frames provide a broader view of the market, helping us stay aligned with the bigger picture and on the right side of price action. The first thing we need to identify is the current dominant trend. Is price in an uptrend, a downtrend, or a range-bound condition? This helps us understand the overall direction of the market. Along with that, we need to highlight key support and resistance levels on the higher time frames, especially on the daily chart. These levels act as important areas where price may react, reverse, or break through. Identifying these areas is critical because the market is fractal, meaning price patterns and reactions repeat across different time frames. A small reaction or shift on the daily or weekly chart can lead to a much bigger movement on the lower time frames. That's why before placing any trade, we always need to assess how much room price has before reaching the next key, higher time frame level. The next important part of higher time frame analysis, especially if you use daily or the 4-hour chart as your main higher time frame, is identifying who is in control, buyers or sellers. So what makes this important? Identifying which side is in control is crucial, because if you don't know whether buyers or sellers are dominating the market, there's a high chance you'll end up trading against the real direction. To understand whether demand or supply is in control, we need to look at the most recent price origin. For example, if the market is in a downtrend and price is reacting from a fresh, unmitigated supply zone, then supply is in control. In that case, we should mainly be looking for selling opportunities, not buys. Supply remains in control until price reaches a fresh demand zone and reacts strongly to the upside. At that point, demand takes control, and we should stop looking for sell setups, even if what looks like a perfect short entry appears on the lower time frame. So, identifying who is in control always depends on how price reacts to fresh, unmitigated supply and demand zones. And always remember this. Higher time frame fresh zones have priority over the time frame you are currently analyzing. This means if price taps into a fresh, unmitigated higher time frame zone from the opposite side, control can shift from demand to supply, or from supply to demand. The next step after completing the higher time frame analysis is to zoom into the analysis time frames, such as the 4-hour, 1-hour, or 15-minute chart. These time frames are one of the most important parts of your technical analysis because once you understand how to read them properly, you can avoid many common traps and make better trading decisions. The reason we use the 4-hour and the 1-hour or even 30-minute timeframes for market structure mapping is that they are mid-range timeframes. They don't usually produce as much noise and misleading information as the lower timeframes, which makes their data more reliable and easier to understand. At the same time, they provide signals faster than the higher timeframes, making them very useful for intraday analysis. So, to perform proper analysis in this step, we need to identify the market direction by focusing on the major highs and lows. This helps us determine whether price is in an uptrend, a downtrend, or a consolidation phase. And once we understand that, we can build a much more precise intraday bias. After identifying the overall direction and the major structural swing points on the chart, the next step is to mark any breaks of structure and then look for potential market structure shifts or changes of character. Once the market structure mapping is complete, we then need to identify key points of interest within the analysis timeframe. These are areas where price has the potential to react and respect. But before we continue, a point of interest can be a fair value gap, an order block, a breaker block, or a mitigation block, or an IFVG. For example, on this 4-hour Eurodollar chart, the most recent bearish BOS is located right here. At the origin of the bearish move that caused this break of structure, we also have a strong inefficiency. This gives us an order block. A bearish order block is the last up-close candle, or series of up-close candles, formed before a strong bearish move that causes a break of structure. So here, I'm going to highlight these two up-close candles as my order block. This gives us a fresh supply zone. And this is exactly where we want to keep our eyes, because it can be an ideal area to look for short opportunities if price pulls back into it. Now, after completing these steps on the analysis timeframe, you should have a clear understanding of market sentiment and what price is more likely to do next. At this stage, we start looking for the actual entry point. This is where the entry timeframes, such as the 15-minute, 5-minute, or 1-minute chart, come into play, depends on the analysis timeframe. Here, we zoom in even closer to look for confirmation signals and finally execute the trade. The main reason we use lower timeframes for execution is simple. They give us a clearer view of price action and allow us to enter with a better risk-to-reward ratio on the micro timeframes. Now, first things first. After zooming into the entry timeframe, we need to wait for price to tap into our analysis timeframe's area of interest and show signs of rejection. Once we see that rejection, the next step is to look for a market structure shift or a change of character. After the market structure shift is confirmed, the next step is to identify an entry model. This could be a fair value gap, an order block, a breaker block, a mitigation block, or an inversion fair value gap entry model. Which one you focus on depends on your trading model and personal preference. We have already covered all of these entry models in our previous videos, so if you haven't watched them yet, you can find the links in the description for a more detailed explanation. And finally, after identifying the entry model and entry zone on the entry timeframe, we can use it to open a position and execute our order. The entry timeframe can also add extra confluence and confirmation to our trading setup, helping increase its probability of success. You can strengthen the setup even more by looking for VSR patterns, double sweep confirmation, or by using tools like Volume Profile Indicator on the entry timeframe. Now, in terms of timeframe selection, if you use the 4-hour chart as your analysis timeframe, I recommend using the 15-minute chart as your entry timeframe. If you use the 1-hour chart for your analysis, then you can use either the 5-minute or 1-minute chart for your entry. And if you use the 15-minute chart as your analysis timeframe, then it's better to use the 1-minute chart for execution. But keep in mind, your analysis timeframe should always be at least twice as high as your entry timeframe. Now, in this example, since I'm using the 4-hour chart as my analysis timeframe, I'll use the 15-minute chart as my entry timeframe. So here, on the Eurodollar 4-hour timeframe, we have an unmitigated bearish order block. This gives us an ideal area to look for short opportunities if price taps into it and shows rejection on the 15-minute timeframe. At this point, I zoom into the 15-minute chart to monitor price action more closely and wait for confirmation. What we want to see is simple. Price should tap into the 4-hour order block, reject from that area, and then create a market structure shift on the 15-minute chart. Now, as you can see, after tapping into the higher time frame supply zone, price reversed and formed a clear market structure shift. This shows that buying momentum is fading and sellers are taking control again. So our 15-minute bias turns bearish, and we can start looking for short opportunities. Now, if you look closely, we also have a bearish order block inside the 4-hour order block. This 15-minute order block was formed at the origin of the market structure shift move, and it is created by these two up-close candles. So now, we have the 15-minute entry area we were waiting for. With these confirmations in place, we can anticipate price to retrace back into the 15-minute order block before continuing lower toward the sell-side liquidity. So here's my plan. I'm setting my entry at the lowest point of the order block with my stop loss just a couple of pips above the higher high. For the take profit, I'm targeting the sell-side liquidity below this swing low, which gives us roughly a 6-1 risk-to-reward ratio. Now let's play out the chart and see how this trade unfolds. As you can see, the order was triggered. After a brief drawdown, price reversed, pushed lower, and eventually hit the take profit, exactly as expected. This shows how combining multi-time frame analysis with a clear roadmap can make your trades more informed and your trading process much simpler. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.